Hey guys, welcome back. Story time with Happy Money. One of you guys requested in the comments, and it's probably good to go over. I'm going to talk about gamma squeeze, how it happens, and options contracts, and how they affect the stock price. It's actually something that I kind of knew about, but then I read this good info on it on Wall Street Bets. Shout out to Natural Profession. It also goes over kind of what options give you the most leverage, which is something interesting I've never even thought about. But sometimes when strike prices, or basically stocks, are so volatile, getting maybe the furthest out of the money options aren't always the best leverage. If you don't know anything about options, this is not probably a video for you. This will not tell you what, I'm not going to explain really how options work. Go to a basic options video. Project Options, a good YouTube channel I like. In the Money is a good YouTube channel I like for options. Both those guys, they've spent a lot of time explaining it, and they do a fair job. I like Project Option probably for explaining it. Anyways, a gamma squeeze and how options affect share price. So basically, when you have an I'm gonna read through this because it'll be easier than me just stumbling around stuff. Okay, so that you have market makers that sell you the options, right? So if you have a call contract, say for basically just over the strike price, say it's at $100, you have a call contract for $110 and it expires in a week. They basically have to provide 100 shares to you at that strike if they think if the stock's going to get that high. Because in case if you exercise it, because you have the contract, you have a right to buy 100 shares for that price. So as the price goes higher, they have to make sure they have those shares. So just if you have that kind of understanding in the back of your head, this will make sense. There are infinite ways that market makers could theoretically hedge against the calls they sell. However, by far the simplest and most prevalent way is to buy some actual shares of the underlying stock. Remember that one option equals 100. One options contract equals 100 actual shares, not options. Okay, so this is the part that people might not understand. When you buy a call contract, they don't necessarily buy up 100 shares right away if it's out of the money. So this is delta. Okay, so the delta of an option represents how much the option would increase if the underlying increased by $1. So delta of 0.3 means that for every $1 the underlying stock moves up, the option will go up by 30 cents. Remember that the initial price of the call option is much less than the stock, so that 30-cent increase is a much higher percentage increase than the corresponding increase in stock. Basically because you're using leverage of 100 shares. And this is kind of the Greeks, which if you don't know about that, that's fine. But delta is one of the things you can find. This is Webull right here. So this shows the delta of these different option contracts. The market's not open yet, so these aren't really updated, but this is what it was probably when it closed. So you can see the delta over here, 0.66. As you go further out of the money, it gets lower. Okay. As an example, you may have paid $10 for a call option with $100 strike on a stock that is currently trading for $50. If the delta on this option is 0.5, then if the stock moves up to $51, the option will be worth $10.50. So the stock moves up 2% and the option moves up 5%. So that's the leverage of options. That's why people use options. A key thing to know about delta is that it is not constant. It varies based on the changes in price of the underlying stock. In fact, as you can see in the chart below, delta is lowest for deep out of the money calls and highest for deep in the money calls. So yeah, it's the lowest up here as we get further out of the money. And then, so this is the strike price on the left here are calls. And it's just 1 on all these down here because these are in the money. Okay, without going into too much technical detail as to why, just note that this makes intuitive sense. If a stock is worth $100 and you have an option to buy it for a strike of $1, deep in the money, then that option should be worth $99 and basically move exactly in tandem with the stock, i.e. have a delta of 1. And that's what we're seeing. All those ones that were in the money all had a delta of 1. Whereas if you have an option you paid $1 for, which gives you the right to buy that same stock for a strike of $1,000, delta has to be very low. Otherwise, say delta was 1, every small 1% change in the stock would cause your option price to double. Don't worry about that. That was confusing. Gamma is closely related to delta. Gamma represents how much the delta changes as the underlying stock moves up or down. So I wasn't really going to get it gamma, but while delta is highest when calls are deep in the money, gamma is actually highest when calls are exactly at the money. You can see this by noticing the slope of the curve in the graph above is steepest at exactly strike price 300. This slope is gamma. Let's not go over gamma. I mean the gamma squeeze. This is kind of, you don't have to know too much about gamma to actually know how the gamma squeeze work. Okay, now we're ready to understand how market makers hedge. This is the point I was saying to make it more simple. Market makers employ delta neutral strategies. This means that their overall position will have a delta of 0 with respect to the stock price. A stock always has a delta of 1 with respect to itself, of course. So how do they do this? They do this by selling you a call option and then buying just enough shares to maintain a delta neutral position. They then constantly adjust their position, buying or selling more shares as the delta of the option increases or decreases. They can do this because they are large institutions who can trade quickly with little cost. The best way to understand this is with an example. GME is currently trading at 137. You buy the March 19, 2021 150 call option, which is currently trading for $26.73. These are the Greeks it's showing. Market maker takes the other side of this trade, because if you bought it from them, they have to sell it to you. When they sell you the option, they now have a delta of 0.498 for each option. And since options contracts trade in groups of 100, meaning 100 shares, that's what they're representing, or what they're worth basically. Their overall delta is 49.8. Let's call it negative 50 for simplicity. In order to be delta neutral, they need to balance this position with securities that have a delta of 50 with respect to GME. Securities meaning shares. The simplest way to do this is buy shares. I guess it doesn't always have to be, but we won't get into that. Each share of GME has a delta of 1 with respect to GME. So the market maker buys 50 shares of GME. Now their overall position is 50 shares of GME and 1 option contract that I think they sold you. 1 times GME March option contract. Yeah, because if their delta is about half, right? So for me, the delta, I like to think of it as like the likelihood of getting in the money. And I'm not sure if that's exactly true or not, but I think that might be. So basically, if this is 0.5, it's got a 50-50 chance of getting in the money. And if it's 50-50 chance, the market makers are only going to hold 50 shares at that current strike price. If it goes down, if the strike price goes down, the stock goes down, they're going to sell shares because they don't need to have more than that many. Oh my goodness. What a scammer. Wow, that was a social security scammer on my phone. That's insane. I've never had that happen. It literally was talking out loud as I was trying to... I didn't even answer it. It just starts yelling at me. Holy mackerel. So yeah, if the stock price is going down, the market maker is going to be selling shares because they don't need that many shares to hedge or basically keep a delta neutral position. And if it goes up, they have to buy shares. And that's when you see prices start to run. That's the gamma squeeze. So if the price starts to get closer and closer to where your strike price is, market makers have to buy up shares to make sure that they're delta neutral. So just in case it gets all the way to your strike price and you want to exercise, they have 100 shares to deliver. That's where you get the snowball effect of stock prices going up. And this is just one part of snowball effect of momentum. Basically, you see momentum, and but this is a gamma squeeze, and this is why buying options that are way out of the money, that are so unlikely with a super low delta, it's not really going to probably contribute to any kind of gamma squeeze. The 2 things to note about this: the market maker wasn't forced to buy 100 shares of GME, like I've seen many users claim. Yeah, they don't have to buy 100; they only have to buy 50, or basically delta neutral. Okay, now we talk about leverage. So it's kind of interesting. Remember that as the stock price moves up or down, delta option. Yeah, that's what I just explained to you guys. Gamma squeezes. Now we're finally in a position to discuss gamma squeezes. Now that you understand how market makers hedge, the rest is very simple. As the underlying stock goes up, market makers that have sold your call options will buy more stock in order to maintain a delta neutral position. That's what I was explaining. yeah, so hopefully understand that at this point. Now you understand gamma squeezes and how market makers hedge. You can actually use this information to determine. So this is something I learned right here when I read this, and I actually didn't know much about. I never really had put much thought into gamma squeezes or how that would work, but that's how it can move the stock price. Market makers are forced to buy shares when the stock price goes up because your option contracts are getting closer to the money, and they have to be able to deliver those shares if they go in the money. In simple form, I guess. But yeah, the leverage part, this is pretty interesting. So if I'm just going to go buy all the way out of the money options on GME, the leverage is actually it's less than 1. So I could be wrong on this, but I believe there's so much premium on those that I would be better off buying the shares at the current price. Basically, my return would be better off. Now I could be wrong on that, but basically, if I bought 100 shares at the current strike price and your leverage is less than 1, then you'll have bigger gains in buying that option. So I'll explain that here really quick on leverage, and you can do the math and figure out where on the option chain you're going to get the best leverage. I don't think you typically need to do this, but with something so volatile like GME, and with people buying crazy out of the money options and spending a lot on it, yeah. So this is a great formula to have. I actually saved this article just so I had this formula. But to figure out the leverage, purchasing leverage equals delta times the stock price divided by the option price. So we'll do this really quick. The market's not open, so you can't see it. It will open in 5 minutes, though. GME is up 5%. That's what's up. Delta. So I'll just give you guys an example. So it was delta times the stock price. Whoops. We'll do the 200. This is in the money. Let's do out of the money. Let's do the 300. So 300 call expiring on today. It's expiring today. 0.34 is the delta times what? The stock price? Is that what it said? Times the stock price. The 0.34 times, we'll say it's at 273 right now. I think that's where it's at, 273. This is going to change once the market opens. You can't trade options extended hours. So once the market opens, these will update. Times 273 divided by, I remember now, what am I doing? The options price. We don't actually have an options price on here. So the bid, oh, we'll just do the last price. So the bid ask, it's not active. We'll do the last price though, which is 6.55 equals 14. Okay. So this number is way off because basically this is going to all update once it opens. But this is your leverage on it, 14. So higher leverage is better, is basically what you want. This will probably, once it opens, this will probably be like 3 or 4 or something. And so, yeah, but also, so yeah, that'll be lower. But if you look up here at the very high ones, you might even see it, even though it's after hours and it's not open. 0.02 times the stock price, which is 274. Really, I should do it at 260 because that'll be more accurate. But I'll do 274 because that's what we did the last one. Because 260 is where it closed, and that's probably where this was more reflective of the price. Divided by 274. 0.0, no, I did that wrong. 0.02 times, what am I doing? Times the stock price. I maybe didn't do that wrong, actually. That's crazy. 274 divided by the option price. Oh, that's, wait, yeah. 0.40. 13.7. Okay, so yeah, as you see, actually, even when it closed, this option down here, the 300 strike, had more leverage. What was it, like 15? 14. So yeah, it had a little bit more leverage than this 800 strike. So basically, that's showing you the amount of premium you're paying. You're paying a premium on the premium for that 800 strike. Don't want to get too much more into that, but that's a good way you can just do the math on it to figure out the purchasing leverage. It's the delta times the stock price divided by the options price. And that's basically gamma squeezes, how they work, and how you can find also the best leveraged options. It's changing. It's always varying depending on who's buying what. I was looking at it before, and at one point it was like around the 600 strike I liked. But they really tightened up quite a bit. Once the stock price tightens up and you get consolidation, they're going to tighten up. When it's real volatile and jumping around like this, some people are going to be way overpaying for options. Other people are going to be getting good deals. So you kind of just have to look around to find a good one. Whew, that's all I got for you guys. Make sure you have a long term. Last word of advice. Sub up, like up, comment down. Happy Money sticks around. Follow us on Twitter at HappyMoneyYT. Peace out.